Oh, hey. Good morning, YouTube. Welcome back. This is Dave, and today's video is the second video on the breakdown of my growth portfolio. In this video, I want to go over two different pies that focus on two very different aspects of the stock market, as well as their overall tax implications. Before I do go further into this video, do me a favor, hit that like and subscribe button for me. And in this video, I do want to go ahead and because I'm talking about taxes and everything, I do want to make a disclaimer here to just say that I'm not a financial advisor, analyst, or even a tax professional. You got that right. Today, not only are we going to talk about the next two pies in my growth portfolio, we're also going to talk about taxes and tax implications. So I hope you have your coffee. I know I do, because today is going to be a numbers day. Let's get to it. Alright, to begin, we have our market indexes pie. As you can see, it has an overall portfolio allocation of 25%. This matches the first pie of the ARK growth funds. And the reason why I chose the allocations like this is to have risk mitigation. Even though I do believe in the holdings within the ARK ETFs, I had to take a step back and look how risky investing in those companies are. By including the various market indexes, I'm hopefully balancing both the risk as well as the reward. So let's go ahead and we'll dive into the market indexes and we'll take a look under the hood, as it were. So first up, we have Invesco's QQQ ETF with an allocation of 27%. This ETF is pretty well known as it tracks the NASDAQ exchange. And the NASDAQ exchange is comprised mostly of technology-based companies. Next up, we have SPDRs, or as I like to refer them, spiders, Dow Jones Industrial Average ETF with, once again, a 27% allocation. As the name states, this particular ETF does track the Dow Jones. Next up, we have SPY, SPY. Once again, this is an ETF through Spider, or SPDR. This one, though, it has an allocation of 26%. Finally, we have VXUS with an allocation of 20%. This is an ETF through Vanguard that tracks international stocks. The reason for these allocations is pretty straightforward. There are a ton of people out there that are much smarter than I am and that they've spent their entire lives studying the market. And those people, they recommend having 80% of your stocks in the US with 20% in the international markets. So, 80% of US-based stocks, 20% international-based stocks. This is a pretty fluid allocation range, though, as economies and societies, they both rise and fall. So we'll see about that. Now, while M1 Finance does show 5 years worth of history on their on the price history value over time graph, let's go ahead and we'll jump over to Google and look at the total history. Here we can see that back in the early 2000s we had a general increase in value before the markets themselves collapsed. This was because of the tech bubble that I'm sure you've heard of. Now, during those days, a lot of companies were being financed that held nothing but a dream, as the internet was kind of like this golden unicorn that was going to make all of our lives so much better. When the euphoria of the internet ended and the stock market, quote unquote, woke up, they wanted to see results. And well, unfortunately, those results just weren't there. And a ton of companies at this time, ended up going bankrupt. And this ended up causing ripples, within other sectors, such as banking and real estate. Since then, though, you can see here that in all four of the indexes, the prices have been gradually moving upwards. There has been three different events that has happened. And the first event, which was the housing bubble collapse in 2008. And then there was another event in 2018. The first event that of the three was, the tech bubble. Now, let me go ahead and pull up PBS here, and we'll take a look at, what caused the crash in 2018 according to PBS. Okay, so as you can see here, I have PBS pulled up, and according to PBS, some of those factors which caused the crash of 2018, or at the end of 2018, was basically those factors included the trade war with China and tariffs, the Federal Reserve raising their interest rates, and then also government pushback against various tech companies for allowing the spread of disinformation and misinformation. Stocks were also, overvalued. And then another thing that may sound contradictory is the tax cuts. These tax cuts ended up fueling share buybacks with various companies. By doing that, that caused their stock prices to become inflated. Now, all of this combined led to extreme fear in the market, which made the house of cards called the stock market come crumbling down. By using the web archive, we can see that on November 30th, the needle on CNN's Fear and Greed Index was all the way to the extreme fear side of things. Now, after 2019, the market relaxed and became greedy once again, which, as you can see, we see a nice uptrend until, you guessed it, the pandemic. This sent not only the NASDAQ tumbling, but also every market. The Dow Jones, the S&P 500, as well as the Vanguard Total Stock Index. All of the markets worldwide, basically crashed. So, but of course, as with everything in the stock market, the market's recovered, and ever since then we've had a run. Prices have been exponentially growing. Now, jumping back to M1, let's take a look at the third pie in this portfolio, which is the REIT market ETF pie. With this pie, I set the allocation to be 15% of the portfolio. And within this pie, you can see that we have a couple of real estate ETFs. The first one is Vanguard's Real Estate ETF, which holds positions in US-based REITs. And then the second one is iShares REIT ETF. That one holds positions in international REITs. once again, we can see that I have this split up into that 80-20 split. Hey, there's patterns everywhere, right? So, if you're not familiar with REITs, these are companies that invest in real estate in order to make income, which they then share with their investors. In almost every financial channel that I follow, everyone talks about how you need to get into real estate if you want to make, tons of money. However, real estate is not a field that I'm very comfortable with. And while I could make an effort to learn, in my particular area of the world, there's actually more realtors than there are available homes or even apartments that are for sale. Basically, the realtor market is oversaturated. So instead, I invest in REITs, which by doing this, it gives me exposure to that market. Now, in order to be a REIT, there are certain requirements that they have to fulfill by law, which you can see here. Here it is, that you can see right here. So, the thing that I do want to point out, though, is that they are required to pay a minimum of 90% of their taxable income in the form of shareholder dividends each year. So, with both VNQ and REET, those ETFs have positions in various REITs worldwide. They then, of course, pay out that REIT dividend to their shareholders. Of course, it's a much smaller dividend yield than investing in the REIT specifically, but it is still money coming in, and it provides much more diversification within the portfolio that I could handle myself. So, I know what everyone is thinking. Why am I talking about dividends and REITs in a growth portfolio? Well, there's two reasons. The first one is actually very simple, and it can be broken down into the basic needs of survival. There's food, fire, water, and you guessed it, shelter. People and businesses are always going to need a roof over their head, and there will always be a far greater amount of renters than there will be owners. Because of just general population growth, the REIT market will grow right along with that. The next reason, as I stated in the beginning of this video, is taxes. Even within a growth portfolio, you might end up investing in companies or funds that pay out dividends. There are two main types of dividends. These are qualified dividends and non-qualified dividends, also called ordinary dividends. In the case of my market indexes pie, those ETFs do pay out dividends that are qualified, with the exception of VXUS, which is, because it's international, that one is an ordinary or non-qualified dividend. Now, the REIT market ETF pie, both of those ETFs also pay out dividends, but those dividends are considered as non-qualified dividends. Qualified dividends, they are taxed at 3 different levels depending on your tax bracket. We have 0%, 15%, and 20%. Non-qualified dividends, also known as the ordinary dividends, those are taxed as just ordinary basic income by the IRS. What all this really means is that qualified dividends have lower taxes at the end of the year. Also, keep in mind taxable events. Anytime you sell a stock, you have an event. If you make money, then that is considered income. Of course, if you lose money, that can also be deducted. However, once again, there are three levels of how much those taxes are, but it's called the capital gains tax, and this is it. The tax rates are the same as they are for dividends. Long-term capital gains are taxed as the same as qualified dividends, and short-term capital gains are taxed as ordinary income. For more information on actually strategizing your taxes, I would highly recommend just consulting with a tax professional, which is definitely not me. So, I know this video is getting to be pretty long, so I'll go ahead and end it here. In the next video, we'll go over thematic investing and how I envision what will happen in the future with humanity, and how that affects the stock market, and also how we can ensure that we keep building our wealth in times of extreme fear and turbulence. So, once again, thank you for watching until the end, and if you haven't done so, go ahead, like and subscribe, and I'll see you in the next. Bye now.